Hey, what I'm about to tell you will make you wealthy beyond your wildest dreams. Okay, I don't really know if it's going to do that, but it will make you a much more informed investor about Realty Income and why I continue to buy this triple net lease REIT. What's up? I'm Russ, a welder who's passionate about passive income since 2018, and sign up below for our free weekly newsletter covering all the weekly portfolio activity. Now, the bulk of this content was pulled from Realty Income's most recent 59-page investor presentation that I highly recommend you click the link below and check out. Now, Realty Income is the fifth largest global real estate investment trust, or REIT, and a triple net lease landlord, which means that their tenants pay for all the costs related to the building like taxes, insurance, and maintenance. And since Realty Income doesn't have to worry about these things, they can charge lower rent. In January 2024, Realty Income merged with a similar competitor, Spirit Realty, in an all-stock deal worth $9.3 billion, which added almost 62 million square feet of real estate to the Realty Income portfolio. That now brings them to 15,450 commercial real estate properties with 272 million square feet across 86 industries, and they believe that approximately 89% of total rent is resilient to economic downturns and or isolated from e-commerce pressures. And the really cool thing is that when you buy a share of Realty Income, you become a landlord to top tenants like Dollar General, Walgreens, and 7-Eleven, and overall, grocery stores make up 11.4% of Realty Income's annualized base rent, with their top two grocery tenants, Walmart and Kroger, controlling over 35% of the U.S. grocery market share. Realty Income has also really been ramping up its international expansion since its May 2019 sale-leaseback deal with the grocer Sainsbury's. Now, a sale-leaseback is a way for a business to raise some cash by selling the real estate they own and then immediately signing a rental lease with the buyer so they can keep using the property. Just like Realty Income did with Wynn Boston Harbor in December 2022, which gave them an entry to the gambling business and a 30-year lease term. They recently just made a European sale-leaseback deal with Decathlon, the world's third largest sporting goods retailer. And as of this recording, they've invested over $10 billion in Western Europe and now have 451 properties, with grocery stores making up almost half of the European portfolio's rent. Now, Realty Income is indeed the monthly dividend company because they've been increasing that dividend for 29 straight years, making them a dividend aristocrat. And even more impressive is their 105 consecutive quarterly dividend raises, all good for an annual compound growth rate of 4.3%. What I like about their business philosophy is that, as they say, their strategy is to invest in clients with a non-discretionary, low price point and or service-oriented component to their business, and that 133 of 183 U.S. retailer bankruptcies since 2018 are associated with companies lacking at least one of these characteristics. In other words, Realty Income likes to rent buildings to businesses that sell cheap or essential things or services that people likely aren't going to be getting online. Now, adjusted funds from operations, or AFFO, shows how much money a company that owns buildings and rents them out makes after paying for the things it needs to keep the buildings in good shape. Realty Income's AFFO for the year end was $4 a share. Realty Income's president and CEO Sumit Roy in the year-end report said, quote, "Subsequent to year-end, we closed on the previously announced merger with Spirit, laying the foundation for 2024 AFFO per share growth guidance of 3.3 to 5.3%. So in 2024, they're guiding for $4.13 to $4.21 of AFFO per share. And since the annual dividend is currently $3.08 per share, that's an AFFO payout ratio of 75% on the low end, which pretty easily covers their dividend. Popping on over to Simply Safe Dividends, Realty Income gets a safety score of 80, safe. And then we see we currently have 198 shares that we're down about 12% on, paying us about $609 in annual dividend income. They have a 20-year CAGR of 5%. They last raised that dividend 4% for the full year, and they have 54 years of uninterrupted dividends. Once again, they do pay that dividend monthly, and as we saw, they do raise it every quarter, paying $3.08 per share per year. Now, their dividend yield is 32% above the 5-year average of 4.43%. The price to forward AFFO is 12.6, so substantially below, and you're paying $12.60 for every $1 of Realty Income's adjusted funds from operations going forward is how you look at that. As we see that their AFFO payout ratio has been ticking down, and they do project it to be 73% next year, but their AFFO per share just steadily climbing up and to the right. Now, most REITs, because they have to pay out 90% of their earnings as a dividend, issue shares so they can expand and grow the business. So their shares outstanding have been going up, as well as the total sales, and as we saw, the AFFO per share is also going up and to the right, which we want to see. And their net debt to capital, 39%, which is pretty low. I get the warm and fuzzies from that. Interest coverage ratio, 2.36%, which means they have $2.36 of operating income to cover every $1 of interest expense. Now, a lot of us dividend investors don't buy this to beat a benchmark like the S&P 500, but just for your reference, you'll see that over the short term that it can't keep up with the high-flying tech-driven S&P 500. Over the past year, O is down almost 15%, while the S&P is up 27%. Looking back 5 years, O is down 2%. It's been a bit of a rough go ever since we hit that COVID crash in 2020. And over the last 10 years, it had been keeping up and at times was way the heck above, headed right into that COVID crash. But then right where interest rates started going up, it started sucking away investors from equities like Realty Income, and you can see what's happened. Plus, you got the Mag 7 driving that blue S&P 500 way up into the right. And if we go back to 1994, though, hey, Realty Income has a total return of 3,700% to the S&P 100's basically 1,000%. So it's why we want to keep reinvesting those dividends and look over many, many years. AlphaSpread.com gives Realty Income an intrinsic value of $56, making it about 6% undervalued. And Morningstar.com gives Realty Income a 5-star rating and a fair value of about $76 and no economic moat. So higher interest rates have really hurt a business like Realty Income because it's made it more expensive for them to borrow cash, which has decreased their cash flow and sucked away some investors to the safety of bonds. But eventually rates are going to be cut, and when they do, I think stocks like Realty Income are going to recover nicely, probably somewhere into the mid-60s, which is about a 20% upside from here on the stock price. So I continue to buy Realty Income inside of our tax-advantaged account to hold it for 10 plus years, hopefully longer, and strategically reinvesting the dividends while expecting very slow capital price or stock price appreciation. And one day, if things go according to plan, we will start using the income from Realty to pay for our living expenses. Did you know that Warren Buffett just bought more of a penny stock that also pays a dividend? So if you click this floating little box right next to my head, I will tell you all about it there.